Lewis mainly sells goods on credit to the rapidly expanding middle income market through the Lewis, Best Electric and My Home brands.
Okay, so from the capitals of Europe and the glossy cities of the Frankfurt, Zetra, Dax and all of that, bring yourself mentally all the way back home to the main streets of South Africa, the small towns, those crusty stores built in the 1970s with the concrete walls and the wraparound ceilings. Now we're talking about South African retail and of course Lewis stores. People will be familiar with them in terms of the storefronts, and you know exactly what you're going to find inside. All that cheap furniture made from goodness knows what, TVs made from goodness knows where, etc., etc.
Market cap here of 7.6 billion rand, PE ratio of 8.9, dividend yield we're talking about is 6.6%. Lewis, as Paul has correctly brought us back, is on home turf.
Absolutely.
And it's a real play on the South African consumer.
Absolutely. So that's why I'm a little bit more cautious when it comes to Lewis. I feel a little bit wary about the state of the South African consumer and the fact that we've already entered an increasing interest rate environment. And if you are selling goods mostly on credit in your stores and interest rates start to rise, you most possibly going to see a worsening bad debt sort of number. Also, when you consider what Lewis has gone through, they've actually had to sell off a lot of the Ellerine stock that they were sitting with. That didn't really help them. But the share price performed well over the last year. So there was a strong performance over the last year by even Lewis in the sector, but it still doesn't excite me.
Look at that share price graph, Paul.
Well, look, it must be said that African Bank's demise has been typically quite favorable for some of the other players in the market. Remember, Johan Enslin, the CEO, Lewis, very nicely run company, fund most of their book themselves. They have a solid reputation in the marketplace. He came up through the store network. They've got relatively well-positioned stores in the right places, in the right towns. And like I say, with Ellerines and Geen & Richards and all the other brands that got fried in the African Bank wind out, you know, that at some level is positive for the remaining players in the market. I want to get that graph
back up on the screen because I want you to talk to me about it.
Well, I think it just follows the trend. You see, in late 2014, people realized that there wasn't going to be an interest rate hike that was widely expected because the fuel price fell. And so quite a lot of the retailers got a little bit of a lift. But then this year that fell away again because, you know, 1 Rand 62 per litre petrol price increase. That's terrible. And then the prospect of tax increases and the sense that maybe job increases weren't going to be forthcoming because inflation's not that high.
Have we previously owned this stock in the portfolio?
No, we've not. I mean, Chris Gilmore, who comes on to discuss the sector with us from time to time, quite likes them, regards them highly, and at times felt that they were pretty attractive. And you can see, to be fair to him, that at times they have done quite well. And they've got a loyal, solid shareholder base, but lately not going along too well.
And Mia, if we lean to you on the slightly more negative South African consumer space, you wouldn't see the fall in the share price as an entry point.
No, I don't think, if I consider the long-term prospects of this company, it's something that I would like to invest in for my portfolio. I think there's too much cyclicality if we look at the share price in any way. And I think the fundamental drivers for this business going forward over the next couple of years and their positioning towards South African consumers is not very positive in my view.
Paul, shall we call it? Is there anything else you want to add before we call it?
I don't want to be too negative though, because as we've discussed also many times before, we have a high rate of new household formation in this country. That means people don't live with their parents their entire lives. They move out into new homes, some kitchen units, and if you're lucky enough to be able to afford a television, that puts you in the game, and people are very eager to obtain those things. So it's going to be a steady market for these things. I think they will do fine.
They're just not going to shoot the lights out in the short term.
I think that's fair to say. Until there's some sort of sense of economic rejuvenation, some sort of new positivity, interest rate adjustments, and that could come, but not immediately.
Not,
well, on the long term, I'm not hot on this one.
Paul, hot or not?
I'm going to go not hot now, just on account of all of this wishy-washy and the petrol price and all the rest of it. We'll see how it is. We'll look at it again.
We'll look at it.